Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for January 27, 2022. A lot of chat, a lot of talk about Feds raising interest rates, a lot of talk about the Feds raising interest rates 3, 4, 5, 6 times. Everybody has an opinion. And the announcement that was made yesterday by Chairman Powell was basically that interest rates are going to remain unchanged until they finish tapering, and they expect to begin increasing rates quarter point every meeting after that, subject to the conditions of the market. It's always subject to the conditions of the market. From what I've seen here is that Chairman Powell, since June of last year, has been jawboning this acceleration that we've seen in inflation in assets, commodities, precious metals, digital assets. And since the talk began of tapering back in June, we have seen a major correction in most of the markets, and now obviously recently we have seen a major correction in NASDAQ, E-mini S&P, the stock market. It has created a lot of fear in the market with the expectation that interest rates are going to derail this so-called economic bubble that we have of artificially inflated assets in the United States. When you take into account the amount of stimulus that has been implemented into the market, it essentially has put the US dollar in jeopardy. Its purchasing power is declining simultaneously that the Feds are continuing to create stimulus. And the question is it time to take away the ball? Is it time to take away the free money? And you really have to take a look at the effects that this pandemic has had here over the last couple of years, socially, economically. We have probably one of the fastest increase in homeless people in the last couple of years. Major cities are inundated with homeless people. Blocks and blocks of downtown Los Angeles has been invaded by homeless people. And not just in California, but in most parts in the United States. And I believe this is a worldwide epidemic that we are not really talking about as much. I think what we have seen here as a consequence of the pandemic is an acceleration of the demise of the Western economic system, the US dollar as the US world's reserve currency. It's being challenged because of the tremendous amount of debt that it's carrying, that is close to $30 trillion. It's growing exponentially, and the tail end of this debt is at risk to explode, literally, if interest rates do rise aggressively. The danger here that we're dealing with is inflation. Is it lasting? Is it temporary? Are we going to go back to the levels that the Fed seems to have a target, supposedly, of 2%, 2.5% on the 10-year, on the 10-year note? And when we take a look at the 10-year note, trading at about 180, it's not really looking for what appears to be a lasting level of inflation. On the face of the Fed's talking about raising interest rates and potentially raising the Fed funds rate, we are looking at the 10-year note trading at about 180. If we're looking at the 30-year note, it's at 208. It's down 7 basis points, 8 basis points. The bond market is pretty much saying the opposite of the general consensus that inflation is going to be lasting. What the bond market is saying here, if we interpret the yield curve or the 10-year note, for example, is that it doesn't appear that inflation is going to be a runaway inflation. In fact, the sign that the yield curve is given is that potentially we may go into a slowdown. It's the opposite of what the hawkish stand of the Feds are representing right now. And so, in terms of reference, a point of reference here, we can go back to 2018 when the same process began, when it was the first time that the Feds raised interest rates a quarter point and the markets collapsed. That to the point where they were forced to backtrack, and instead of rising interest rates, they began the decline to negative rates, which is where we are right now. You're looking at the CPI, PPI, the PPI running at about 7% inflation rate, and you're looking at about 180 on the 10-year note. That's a 5.2 negative real yields, real return, in comparison to the 10-year note. And even if you compare it to the 30-year note, you're looking at about a negative 3% yield. And so the issue, in my opinion, is that the Feds are stuck between a rock and a hard place. They cannot, in my opinion, raise interest rates aggressively without collapsing the market.
And the workforce of today is more fluid and dynamic than ever. And from the bedside to the backcountry, every employee deserves a world-class digital experience. Introducing VMware Anywhere Workspace Solutions for Chrome OS, the best way to give your employees the simplicity of a Chromebook with all the apps they need, thanks to VMware's cloud-native VDI and unified endpoint management. And in the modern workplace, you shouldn't have to pick and choose which employees get a sub.
Investing.com, I apologize for that. Coming back here, it's a very tricky position to begin to taper, to take away the punch bowl and to begin to raise interest rates. In an economy that, according to the yield curve, seems to indicate, in fact, the possibility of a slowdown, and the fear really that I see, the panic that I believe is going to be created as we move into this later part of this year, the second, third quarter of this year, is how much is the economy going to slow down? The IMF just put out a 2022 forecast and expects the world economy to slow down. We haven't yet seen the numbers of the results of the Omicron panic that we had last quarter, and how that's going to reflect in the economic numbers that should be coming out relatively soon. So when we talk about the fundamentals of the market, I keep referring to 2008, when it was the first time the Feds raised interest rates, that essentially the market could not tolerate those, and instead the market really went into a tailspin and forced the Feds to reverse course, which is potentially what I believe the market is going to demand. I believe that based upon just the debt levels that we're in globally, which are growing exponentially, global debt is in excess of $300 trillion. It's 125, 130% of GDP. It is unsustainable as it is right now. Never mind if rates begin to rise. Just think about the pressure of raising rates a point, or the 10-year note going back up to 2.5%, which seems to be the threshold for the Feds. Even so, if inflation is running at 7%, you're still running at a deficit, negative real return. So either rates have to go up, or the level of inflation has to come down and reduce that gap, that negative gap. And that's the problem, is how do we narrow that gap, that negative gap that essentially is about a 4% negative yield against the US dollar. How long can investors maintain this loss of purchasing power in the US dollar? So I think what we are seeing here is obviously countries like Russia beginning to talk very loudly about eliminating using the SWIFT system or the US dollar as the reserve currency in transactions with China. They want to be able to deal in their local currency against the Chinese yuan directly, away from the US dollar. So there is a consensus right now that's building against the US dollar for obvious reasons. The US dollar is imploding and causing a level of inflation that we haven't seen in 40 years. With negative interest rates and a record world debt. Just the U.S. alone, close to $30 trillion. It's a different situation than we were back in 1971. And taking a look at the values for gold, and I'm focusing on gold and silver, the values of the precious metal is very much like buying gold back in 1970s when you factor in the inflation rate. Relatively speaking, I think the cheapest assets on the board are gold and silver. One of the things that we are beginning to see with GLD here is an inflow of capital that has come into GLD and begin to buy the ETF. And that is a really positive sign that money is coming into the sector, into the metal sector. The metal sector has been skewed, or you might say deviated, by the interest in Bitcoin. To talk about specifically Bitcoin, it's a reflection of what I was saying a little earlier here with the U.S. dollar imploding as a consequence of this tremendous amount of stimulus that we've had. And the inflation level here that I want to clarify, that essentially it's not just in terms of price pressure that we have because of the lack of supplies or the bottleneck of supplies. But what we're talking about is the currency is imploding. And it's reflected, it has to be reflected now in the values of commodities, foods, essentials. We first saw that reflected in the stock market. Since 2020, we saw it reflected in gold by going to 2,089. And GLD at the time went up to 194, the major gold ETF. So my focus from a trader's point of view, and this is what I'm sharing here, is that in terms of a risk-reward ratio, there is absolutely no other instrument that is essentially offering the risk-reward ratio, particularly in a market like silver, which is extremely, extremely volatile. And when we see moves in metals, particularly in silver, we can see substantial moves in a short period of time. I want to focus for a minute and feature Hekla Mining Company, which I am beginning to build a position, and I wanted to share this with my audience here and my readers, that I believe Hekla is offering an incredible opportunity to buy and hold the stock, I would say, over the next 12 to 24 months. The Hekla Mining is basically the second largest gold producer in the United States, and it's one of the oldest silver mining company. And so it has the credibility of longevity, and it's been around for a long time. And I think it's offering an incredible value, not only in terms of price value, but also in terms of simply intrinsic value in buying this stock at these levels here, that essentially we're looking at almost a 50% correction from the high that we saw back in May of 2021, June. And I believe that the stock has the potential to test this high of 944. And so, very strong recommendation to buy and hold Hekla as a silver asset that you can build, and you can hold it, you can buy, and add to your position. I strongly recommend accumulating physical gold, physical silver, and I do agree that you should have a percentage in Bitcoin. These markets, I believe, are going to be the beneficiaries as we move into the reality, basically, that interest rates are not and cannot, under this condition, without any kind of economic growth indicating, cannot go up. And just price pressure alone is not, again, a reason for the Feds to raise interest rates. It is actually advantageous for the Feds to allow inflation to take its course, even though they're talking hawkish about inflation. We are featuring Hekla Mining Company, and if we take a look at the price structure since the bottom that we saw back in 2020, we pretty much have seen a correction coming back down to almost 61.8% of this whole move up. Since the high of 944, we came down to a low of 450 on December 13th. And we have reverted from there, making a high of 509 here recently on the 17th. And what we seem to be building a base at this level. Taking the Fibonacci retracements from the high of 944 to the recent low that we saw of 450, the market completed yesterday a 23.6 Fibonacci retracement. If we look at the 38.2% target, you're looking at about 635. A 50% target is 692. A 61.8% golden ratio target is 748. And a 78.6% retracement is 829. If we close above 829, we stand to break out and challenge the highs of 944, putting into place the Fibonacci extension 161.8% of 1230. And I believe we will see this prices completed over the next 12 months, if not sooner. Be patient, my friends. The time is coming. Continue to accumulate on any corrections and look for reversions to unfold from these levels here. 1780, 1800 is the bottom of this counter swing correction that we have, and holding that level should revert the market back up. If we close below that level, we may open up the possibility of testing that 1750. But I believe if that is the case, that this would be an extremely incredible buying opportunity for gold and silver in 2022. Have a great day, my friends, and I will talk to you during market wrap later this afternoon at 2 o'clock. Take care, be well, have a great trading day.